Hey, it's Richard with Matthews Wealth Management. We're going to be covering the April 2023 market update. This is the asset class performance. So we'll just jump right in. NASDAQ has been, well, let me just cover the whole year. I think it's been kind of a strange year. I've explained this. We're in the middle of quarterly meetings, and I found some time to get this put together. But we can see January was a great month. February, not so much. March came up, and April went sideways. That's where we are. This is year to date. Today is my dad's birthday and Rhonda's birthday and Wanda's birthday, but May 10th. So we've got a little bit of overlap here, but you can see it's still kind of a sawtooth going sideways. Overall here, 17% NASDAQ. So that's growth, right? And when we're talking about growth, especially large cap stuff, we're talking tech, right? So Amazon, Apple, Alphabet, that kind of thing. Let's see. Diving into S&P 500, we can see the same kind of trend up, down, up, sideways to a smaller extent, right? Because S&P 500 is a much broader sweep across the economy, so up 8% there. And just to throw together the Dow Jones Moderate Portfolio Index, we tend to kind of follow this, I guess, tracking this. This quarter has been awkward, I should say, with the benchmarking that we're using, just because if we look past January into last year, we didn't take the losses that most people took. So try to compare volatility between benchmarks, and it's a nightmare. But still, we'll stick with the Dow Jones Moderate here for year-to-date picture. Up, down, not as much return, actually, as you would expect with what we saw on NASDAQ and S&P, and then still the sideways. Actually, a little bit of tapering here as we are year-to-date on the Dow Jones, only up 4.27, so you can see the 18, the 8, and the 4.2. So a lot of cuts along the way, I guess, is what we're seeing as you add more bonds into the picture. So equities, U.S. equities to be specific, we got large cap, big companies, mid caps or medium-sized companies, small caps are small companies. Just a refresher. I know some people tend to forget that, or they're new to tracking this stuff, and I should explain it. Value is a certain type of business that's set up and usually dividend payers, cash flow, high cash flow. On the flip side, growth is all about R&D and coming up with the next greatest thing. Core is kind of a blend across, you'll hear me interchangeably use core and blend. But what we can see here in the month of April, a higher concentration on value returns, right? So the top number is our monthly return. The bottom number is our year-to-date, right? And so the biggest year-to-date performer, as we already covered, NASDAQ, that's going to be the large cap growth, big tech stocks. But we can see a bit of a shift, I guess. It's not a big shift, but you know, it's worth looking at these trends, I suppose. So 0.5%, 1.6, and 2, right? So a higher percentage of capital is flowing into value is the best way to look at that. Also, the trend continues from growth of a -6 in mids to 0 in blend and just under 1% or a little over 0.5%. So again, it's better to be on the value side for large and mids, but it's a wave on the bottom here for smalls, right? And small growths across the board year to date has been the place to be. A lot of that had to do with the banking crisis, a little bit of balance sheet creation, BTFP, FDIC, all the fun acronyms that we love and enjoy so much here. But yeah, so it's not the right play year to date to be on the value side, but this month it is the right place to be on the value side, except this is a lot of bank stuff going on in the small, the regional and mid-sized banks. But let's jump into international. International is up another 3% on the month. Emerging markets is down 1.11%, and a very large discrepancy year to date between international and emerging, and probably on the wrong correlation. We would typically expect on a good year for emergings to take off, but this is about currencies, right? So international represents, European companies and mainly based in the euro or the Swiss franc or whatever. Japanese yen would also be international. Emerging markets, Brazil, Russia, India, China, South Africa. Everybody's heard about BRICS lately, right? So emerging markets, as far as everybody growing and joining the BRICS with the Southern Hemisphere, Indonesia, Saudi Arabia, UAE, all these big global partners of ours are dumping the dollar. So this will be interesting to see how these two play out. We used to look at international as a very good hedge against U.S. equities, and now they're kind of positively correlated. So it's not really the hedge that it used to be, and I'm considering the emerging to be a bigger hedge to U.S. equities, and that'll, stay tuned, I guess, because we're going to reallocate here pretty soon. Alrighty, bonds, everything's up, everything's green, right? Why is everything up? Well, everything was down last year because of interest rate risk with the Fed raising funds rates, and that sends a ripple effect out into the bond world, which sent prices down, anywhere from 10 to 20%, depending on your duration and credit quality. But this year, with the threat of the Fed cutting or pausing the rate hikes, cutting rates potentially, what we've been doing is moving from our short term into long term. And you can see this is good correlation, 2, 3, 6.5 for the duration premium. And that's what we would expect. That's why for 5 months now we've been buying into long-term bonds. If you're in my client meetings within the last week, I'm flipping that script a little bit. I'll do a separate video on that. I don't think that putting that into an asset class, nobody's watching these. I mean, a few of you are, but in general, what I've got to say is probably much more interesting, and I'll do a standalone video for why we may be considering not doing the long-term play, because yeah, obviously there's free return there, but man, there's a risk on the horizon. Tips, 3.5, everything's doing what it's supposed to do. Cool, yay. High yields, I'm terrified of high yields. I think that there'll be a lot of corporate defaults. The banks are kind of the tip of the iceberg because, where do other corporations borrow money? Banks. So we'll see what happens on renewing some of these corporate bonds, and especially junk bonds. I mean, they're not going to be able to price against, say, 5.5% federal funds rate, right? But yeah, they're up 1%, 4.6. You're not getting paid properly. As you can see already year to date, the 4.6 versus the 6.5 should have been in treasuries, right? Instead of taking this risk, which is much higher than I think the market is perceiving. Let's jump into commodities. Oh, Richard, other Richard, not me, but the other Richard who said, put crypto or Bitcoin up there. I did consider it. I didn't do it. I thought about it. I might make a better argument as to why I should do it, because it's not a commodity. It's not a currency, but I know some people track that and some people want to see it. In fact, if we had to throw it anywhere, here's where it is, right? Not really, because we now have negative correlation with tech and Bitcoin. So you're onto something. I might get there. Anyway, oil, we're starting to recover on the price of oil. It took a big swing down into the 70s, and I've said 80s about where we should be. It's where we started. It's where we'll end. But we made up 2%. We're still down 3.5 year to date. Gold continues its march forward, up another 1%, so about 10 year to date. Real estate's kind of bouncing back with the idea that maybe rates will be coming down, but office retail is a little precarious, and there are tons of articles out there. Just go read an article about why real estate may not be the right thing. But for buying land to build a house, cool, especially in Greenville County. This is an awesome location, right? That's the key here. But overall, the yield isn't worth the risk of default. That's probably the best way to phrase it. So to boil it all down, NASDAQ's up 17.71. This is as of the end of April, not May 10th, like today. S&P 9.17, moderate 4.89, and we are trailing pretty good here at 3.18. If we're comparing to a moderate benchmark, like I said, I'm annoyed by benchmarks, but hey, let's be transparent. Let's be upfront. We're trailing it. There are reasons why. We've got a fairly heavy cash position. And like I said, I'll do a reallocation video here to kind of show what we're thinking. So anyway, hope you enjoyed it and try to make it short. See you next time.